welcome to Money Talk, a Mainsail Financial Group podcast series where we host industry experts and local professionals to really share some guidance, some tips, some tricks in the areas that we don't necessarily get a focus on day to day. Today we want to thank Jeff Gilbert for joining us. Jeff is not only an attorney but also an owner of his own estate planning firm just up in...
It's in Muckletew, yeah.
Yep. So he specializes in the area primarily, but King County, Snohomish County, I think you name it in Washington. So we're really excited to have Jeff here to talk a little bit about some estate planning considerations, especially with some previous federal changes, some Washington state-specific things to consider, and then also maybe talk a little bit about what might be ahead here. Thank you for joining.
Well, thanks for having me, Brandon. I appreciate it.
Yeah. And before we jump into it, I'll share that we're at Honor Coffee just here in downtown Bellevue, so really happy to be here, and actually the first time I've had a chance to come out here, so it's kind of nice to check out the scene out here. So.
Very nice.
But yeah, with that, we can go ahead and jump right into it. So maybe to start, Jeff, let's maybe kind of follow the framework I laid out. Let's talk about what has happened.
Okay.
So the biggest thing I think that maybe would be helpful for everybody to go over is just some of the history around not only the Secure Act 2 that just passed, but also the first Secure Act that passed back in 2019 and what that meant from an estate planning.
Sure, yeah. The 2019 is the original Secure Act passed, and so that had more profound changes than this most recent for estate planning standpoint. There were some positives, but one of the big impacts from an estate planning standpoint was that you had the reduction in the transfer of the inheritance. So the individual that used to, if a spouse, one of the primary was you used to have a transfer that would take place over the course of an entire lifetime for the recipient, with the exception of a spouse. The spouse got a rollover. First spouse passes away, the surviving spouse gets to roll over the exemptions and the IRA into his or her own IRA. But unfortunately, what used to happen is that the children, for instance, depending upon what their ages were, they got to roll that over and spread the gain out. The required mandatory distributions were over the course of their lifetime at that time. So a 40-year-old might have an 85 year expectancy, so there's a 45-year period of time that they get to roll over those required mandatory distributions. That changed in 2019, and now it's a limitation of 10 years. So that was a big impact from an estate planning standpoint.
Yeah, and maybe before we move on to the newer version, can you talk a little bit about how that differs if it goes to I believe that there's some different qualifications, whether it goes to a beneficiary, a named beneficiary, or just if you have it go to your estate, a non-named beneficiary. Can you kind of talk through some of those nuances?
Yeah, certainly. So if that's one of the things that I'm sure you deal with a lot, that you want to make sure that you have named beneficiaries, because they do get the ability to at least spread the gain out. Because remember, IRAs, with the exception of Roth IRAs, have never been taxed, and so at some point in time they're going to get you, and if they don't get the original contributors, then they're ultimately going to get the beneficiaries on that. If you name an individual or a qualifying trust as the beneficiary, they get that benefit of rolling it over for a 10-year period of time. But if instead it goes out to the estate, there are no named beneficiaries. Really, at that point in time, all that income is declared at that in that year. It's a big hit to what will ultimately be the estate beneficiaries. Yeah.
Thank you for sharing that, because I think that's really important, right? And obviously it's impossible to always solve for all scenarios, but we've been talking a lot about adding contingent beneficiaries to try and help reduce that impact, or trust where necessary, that kind of thing. So.
Yes. The professionals at that point in time can go ahead and they can make sure that the beneficiaries are setting up inherited IRAs and going that route. So,
Okay. And then, so now moving forward a little bit, I know that there's not nearly as much change with the Secure Act 2.0, but is there anything you're seeing in there that affects the state?
Primarily the changes are, on the one hand, they're more positive changes than the negative that took place in 2019. You have an increased amount that you can give on an annual basis without being subject to any sort of a gift tax filing. So that's moving up. That's this year. That's $17,000. And at the federal level, the amount that at the federal exemption level is been raised significantly. It's at $12.9 million. So effectively, a married couple can transfer $25.8 million without being subject to federal estate tax. Now, the Washington state is a much lower threshold, but that has been raised significantly this year. The concern is what is going to be happening in a couple of years.
Sure. Okay. Yeah. And before we get to that, 'cause we want to come back to that for sure. Before we get there, just high level, can you kind of share just like conceptually how that estate tax exemption level works and where somebody might run into it, basically?
Yeah, it's it's at the point in time when for the first spouse to pass away, if there's a married couple, first spouse pass away gets an unlimited marital deduction as long as you're a U.S. citizen. The impacts at the first spouse's passing a little bit less than when the second spouse ultimately passes away. At the federal level, they give something called portability, which is really a nice thing that is for an estate planner. What it really means is that for a spouse, really without doing any sort of sophisticated estate planning, the first spouse to go, if they don't use their $12.9 million exemption in 2023, the surviving spouse gets to use the first spouse's exemption to tack on so that ultimately when the surviving spouse passes away, because that's when they're looking at this, as long as that amount is under 25.8 for a married couple, there's not going to be any federal estate tax. So that's a wonderful tool. Yeah.
Okay,
so.
And basically, if they do go over, then it's basically is it 40%?
Yeah, I believe it starts at 37%, but they get that excess they start taxing very, very rapidly, and yes, that's.
And then, can you talk a little about the Washington State levels?
Yeah. Yes. So Washington State has a much lower threshold, and that used to be a long time ago. That was $600,000 for both the federal and the state. And when I first started practicing, that was the threshold amount, and they were tied together. But they diverged, and Washington State. Their level right now is $2.193 million, so roughly $2.2 million. And unfortunately, Washington State doesn't allow that really kind of easy portability that the federal government does at the federal estate level. They instead, you have to do some estate planning with that and form a bypass, a credit trust, and then ultimately fund that when the first spouse passes away. And that will then allow both upon the death of the surviving spouse, then there's $4.4 million under 2023 guidelines that can be transferred estate tax free. The good news is that the tax rate is much lower. I believe the tax rate is 10% on the first $1 million exceeds the exemption. So,
yeah. And that tax rate doesn't ratchet up quite as quickly as
yes, yep. And I believe it taps out. It might be 18%, but yeah.
Mm-hmm. Yeah, and can you also talk a little bit about how in Washington, so at the federal level, I'm simplifying this, but the gifting and the estate tax inclusion are somewhat tied together.
Yeah.
Can you talk about the difference here in Washington State?
Yeah. So that's the good news with. There's some really good things with the federal, the high exemption, the portability, but they, at the federal level, they really want to protect against the gifting that has taken place in a given year that exceeds what they see as a threshold, and their threshold is $17,000. If you, for instance, if you make a gift to a child of $117,000 in a given year, you have now exceeded that threshold by $100,000, and that, what happens at that point is that reduces the amount that you can give at death. So it reduces that overall threshold. For a state, that is not the case. You can accelerate your gifting during lifetime to reduce the size of your estate. So we find that as an estate planning, you wind up doing that a fair bit, because for most people, it doesn't make any difference that they might have a high gifting that requires that will reduce their overall federal estate tax level. It will only reduce it at an amount that they'll still not be over that threshold, and then they'll have the ability to then get down below the Washington state threshold. So we see that a lot of accelerated gifting in a given year for purposes of avoiding Washington state excise tax. Yeah.
And I realize I'm simplifying this a lot, but basically I think if I'm hearing you correctly, if your estate is between the Washington state level and the federal level, that's where this opportunity rises, where you can gift and reduce your estate, but it's not going to affect you because you're not worried about the federal.
Yeah, absolutely. So if you're a single individual, if you're 2.193, if you're between 2.193 and 12.9, that's one of the tools that an estate planner will use, is like, let's get that level down below the state threshold. And even though you are making gifts that essentially are going to require a gift tax return, but not a gift tax, you don't actually have to pay the tax off of it. The federal government wants to keep track of what has been happening, and so they'll require that if you're making that gift over $17,000 in a given year to one individual, that at that point in time you have to file a gift tax return. Yeah.
Okay. Yeah, that's super helpful. Switching gears here a little bit, let's talk about what's ahead, because I think offline you had mentioned some things that you're watching.
Yeah, it's from an estate planning standpoint, really very few of the clients that come in have a federal estate tax problem, because the threshold has been so high, and we've kind of a little bit in estate planning kind of have forgotten at that federal level. So what's upcoming is an end and a sunsetting of that threshold. So we're not sure where the threshold might be in the year 2024 and 25, but right now it's scheduled to. The law says that will sunset after 2025, and the new amount will be reduced to $5 million. So now for a married couple, assuming that we still have that portability function, you're still going to be at $10 million. But for a single individual, it's at $5 million. So that that difference between what is being paid at the Washington state level versus the federal level is going to shrink unless Congress does something about that, and we all kind of know the climate that is going on right now. So it's very likely that overall threshold is going to reduce by at some level. Yeah.
And that's part of the Tax Cuts and Jobs Act, right? That's what.
Yes, that's correct. Yes.
Yeah. I realize that you don't have the crystal ball on this, but as we look ahead, so this is 2025, 2026, we will have a presidential election in the meantime. Do you think it's more likely that they would revamp this heading into it, or that they would actually just let it expire? I
know the last time that that the federal exemption was scheduled to sunset, there was a lot of attention paid by Congress to it, and in fact, I think it was 2011. There was a year where there was no federal estate tax, and then it came back, and then it kind of ramped up. Bottom line is, it probably will make a difference It tends to be that a Republican Congress is going to downward pressure on the taxation there. So in other words, there's going to be that the exemption levels will tend to be higher. But right now, without doing anything, they kind of created that. Say it sunsets, it's going to be $5 million. So unless there is an agreement to change that, that's what's going to happen. So
I doubt you're making too much adjustment for that yet, but as you get closer, that creates a lot of estate planning opportunities as well, if it's going to sunset. Right?
Yeah, exactly. And so that's where, in these next 2 years, what I'm seeing, and I'm already having these conversations with clients about maximizing some gifting, because if you do the gifting in a year where the exemption level is higher, they don't have to, but they will generally go ahead and honor that, even though subsequently the exemption level goes down. So right now, again, in 2023, we've got a $12.9 million exemption each. So you could make gifts of a substantial amount of money and reduce the size of that estate, even though in a couple of year period of time that you have survived until you're no longer able to do that. So that's something that is going to be happening in the next couple of years. Is we're going to be having some gifting through various. You can just do. There's a lot of different tools, but you can do a straight out gift, but you can also do giftings where there's family limited liability companies where you want to ultimately transfer that the assets to kids, but you still want to maintain the control of those. That is a real common tool to do. That's gets it out of your estate. You're ultimately wanting to make that transfer to the children anyway. But you don't want to necessarily give it to them now where you don't have any control, and there's things that can be done there. So yeah.
Okay. Yeah, that's really helpful as we get closer to that. As we start to wrap up, is there anything else that you're watching that you want to share? Anything we missed today?
No, I think that's that is from an estate planner standpoint. That's what we're looking at doing. A lot of times estate planning gets into financial planning. And investment planning, and you start looking at, do you have investments that are conventional IRAs? Do you at some point in time make a decision to convert some conventional IRAs to Roth IRAs if your income isn't substantial in that given year? That will happen. Sometimes clients will want to do that because they don't want their children to have the tax burden that will come down the pike. Right now it's within a 10-year period of time after passing. But they can do that. They can take the financial hit now, convert it to a Roth IRA, and then when that beneficiary ultimately receives it, they're receiving that without the income hit. That's there's two different, kind of dancing around a little bit. There's the income tax level, but there's also estate tax, which estate tax is a completely different tax on the conveyance of an asset, whereas the income is obviously income on an IRA that has never been taxed. So they're going to get you. So.
Yeah, that's really important. So, I know part of why you're sharing that is, especially if the assets pass to a kid, a beneficiary who's making good income too. You could lose, a lot of it very quickly.
Yeah, absolutely. And it was less of a concern when you could stretch out that IRA over the course of their lifetime, but now it's truncated, and so it's going to result in income impact to that child. So yeah,
I think that's a great point to wrap up. So if anybody wants to get in touch with you, anybody has any questions or maybe want your help, is there a good way to?
Yeah, absolutely. I'm just very simple. I'm old school. I'm a solo practice. Just contact me through my office. I'm in Mukilteo. Gilbert Law Firm, and my email address, gilbertlaw@hotmail.com. and contact me, and you're usually going to get me. I try to, have a fair bit of interaction with the client just on their initial call. And find out where they are, what they need, so that they can kind of get an idea of, what this is going to cost. So then they come in, they have a pretty good idea of what's going on. So yeah.
Perfect. Well, thanks so much for joining us.
Appreciate you having me. Yeah.
Really helpful.
Yeah.
And thank you guys all for joining us today as well. Of course, if you have questions for Gilbert, or Jeff, Gilbert, feel free to reach out to him. But if you have any questions for us, you can reach out as well. info@mainsailfg.com.